So thank you all so much for joining us in the first in our series discussing our World of Private Clients report. I'm Wendy Walton, Head of Global Private Client Services based in the UK at BDO. I'm delighted to be joined by Jeff Kane, who chairs our Global Centre of Excellence for Private Client Services and is based in the US. We're also joined by Paul Ayres, who is a partner in our UK tech team, who is going to keep an eye on the questions for us and come back at the end and summarise for us. In addition, we'll be playing a video from our colleagues in Singapore and Australia, who will give us their views from their region, as well as some thoughts on the structuring of family offices, which have seen a boom, particularly in Singapore. We thought that it was a bit mean to ask them to join us live in the middle of the night. So please do feel free to put your questions in the chat box as we go, and Paul will pick them up at the end. And just to manage expectations, our presentation should last for just under an hour, thereabouts. So Laura, could we go to the next slide, please? So the World of Private Clients is our first research report into what the world of private clients is thinking. If you're on the call and you participated in our survey or in an interview, I would just like to say thank you. And our aim is for this to be a multi-year project so that we can see how attitudes, hopes and opportunities as well as challenges develop over time. Today, we aim to go through some of the high-level commentary from the report, and later in the year, we'll run 4 further webinars looking at the 4 key themes in more detail. So the next slide just shows the 4 key themes from our report, and they were tax transparency, relocation, family and generational wealth, and the advisor of the future. So we will touch on each of these briefly today. So the next slide is our survey findings at a glance. So we were just about to launch our research project in March 2020, just as the global pandemic hit. So we delayed the launch until September of 2020, the summer of 2020, and found that this was a really interesting time to have carried out this research, and it will be fascinating to see how the themes change over the coming years. I think COVID-19 has been and still is a leveller. Everybody has been impacted to a varying degree, and it has given everybody a period of reflection to think about what truly matters to them. And following that period of self-reflection and an initial wait-and-see attitude, individuals are now thinking about turning their thoughts into detailed plans, which they want to action. The majority of our respondents were planning either significant or thoughtful alterations to their plans, to their life plans. Our respondents expect there to be an increase in tax rates around the globe, or the introduction of further taxes, such as wealth taxes in many more jurisdictions. Recent research in the UK, for example, showed that public attitudes demonstrate a clear desire for wealth to be taxed more relative to labour. All of this is in order to pay for the government support that has been given to local economies and businesses to effectively pay for the pandemic. However, this is still balanced with jurisdictions wanting to be competitive and attract wealthy individuals and businesses, such as Spain and Portugal, for example. We also found that new investment opportunities and more diverse portfolios are being sought. The next generation look at matters through a very different lens, and social purpose sits alongside and sometimes above wealth creation. So this is an additional filter for us to consider, as the ESG agenda is more prominent and there is a growing public focus on privilege and equality. Our report highlights that ESG and philanthropy are huge areas of focus driven by the next generation. Everybody understands the need for transparency and can see that the direction of travel is clear, but also recognise there are concerns about privacy if information gets into the wrong hands, and that reputation management is also being considered more and more by families. And Jeff will cover this later. When it comes to succession planning, it's forecast that trillions of dollars will pass to the next generation over the next 10 years. Our respondents said that succession planning failure lies at the feet of the incumbent wealth owners who find it difficult to make the decisions and put their plans into action. And then whilst a stable tax regime is an important factor in making a decision regarding relocation, political stability and lifestyle are the dominant factors. And finally, we took a look at what is expected of a private client advisor of the future. And I will look at this in a bit more detail later. But the expectation is that we'll need to be more multi-skilled, not just technical experts, but tech savvy, or we will be left behind. So to summarise, wealthy individuals and their advisors face a more complex global landscape, huge economic upheaval, a global pandemic, and a stronger emphasis on doing the right thing for society and the environment. So if we move to the next slide. So the dots on this map show where our respondents were from. Although it's very hard for you to see where they them, they were from around the globe, and the larger the dot there, the more respondents from that location. And then on the next slide, we just show that over 50% of our respondents were high net worth individuals or a family member, and then approximately 1/3 were a professional advisor to the high net worth community. And the balance were members of employees of a family business, and then the balance spread across a variety of areas. So on to the next slide. So as I mentioned, our survey was conducted right towards the start of the global pandemic. And the biggest concern for the respondents at that time was a cooling economic and investment climate. Some 63% said that, followed by the prospect of an increasing tax burden. And then asset protection and travel restrictions were close followers. So that introduces our report to you. I'll now hand over to Jeff, who will walk you through our findings regarding tax transparency.
Thanks, Wendy, and welcome everyone. We're pleased to have you with us. As Wendy indicated, our survey focused on 4 particular areas. And the first one that I'm going to talk about is global information sharing, or for lack of a better description, what's been called transparency. And while people generally believe that in and of itself, transparency was not a bad thing, it just seems like there are unintended consequences, and I will talk about those a little later. So how did this global information sharing come about? How did it get to be so pervasive, and where are we headed? Well, global information sharing has really been around as an idea for a long time. And it's particularly driven by countries looking for tax revenue. I would think that the current push that we're under right now really began when the U.S. With the U.S.'s efforts to find money that its citizens had in Swiss bank accounts. And you've all read about the arguments going back and forth between the U.S. and Swiss authorities about finding that information. The U.S. is, I think, one of only 2 countries in the world that tax its citizens on their worldwide income. So while this may not be an issue in other countries, it certainly was one here, but it really gave rise to this issue of transparency. The second real media exposure came with what was called the Panama Papers, the information of the Panamanian law firm that came to light. Again, in and of itself, many of those investments were not illegal, and there may be very good reasons to have accounts or investments in Switzerland or Panama or the Cayman Islands or the Channel Islands or any other jurisdiction. The issue really comes down to disclosing them appropriately for the jurisdiction that taxes you, and then obviously paying tax on the earnings. But when you think about it, media shaming is not necessarily new. And I'm reminded of a column that the Wall Street Journal used to run a number of years ago. It was once a week. It was in the right-hand column of the front page, at least in the US edition. And it usually focused on an investment or a tax scheme that some wealthy family or families or group had invested in. And it may not have been illegal or insidious or anything else, but the optics were a problem. At about the time of those articles, I had one client call me up and say, one of your jobs is to make sure that I never appear in that right-hand column. This really then kind of raises the issue of reputation management, and it is becoming a bigger and bigger focus for families. 92% of our respondents indicated that they take that into account when making decisions. Information is global, and it is relatively impossible anymore to hide anything. And when talking about reputation, one of our respondents also said that no one can take your reputation from you. You can only give it away. So where are we headed? Well, there's the ever-changing political landscapes, including in my own country. Technology is becoming much more pervasive and much more sophisticated. Sharing data is a whole lot easier than it ever used to be. So it is expected that this will only increase. As I mentioned, the US will continue to tax its citizens on their income wherever it is in the world. The EU wrote what was called DAC 6, which focused on cross-border reporting. That was very onerous and in the beginning, but it has been massively scaled back since then, but it is still there. The OECD developed common reporting standards, CRS, in 2017. There is increasing collaboration among jurisdictions around the world. And it is at this moment estimated that automatic information sharing now covers 90% of GDP. So it is pervasive. Our respondents indicated that they really understood and accepted the global information sharing requirements, and they want to comply. But complying is becoming increasingly complex, especially as rules continue to change, and confusing. The new rules are emerging, tax rules are emerging in many countries, tax burdens will continue to grow, and reporting is bordering almost on, as I mentioned, onerous. One respondent, I think in particular, looking at the previous DAC 6 rules, called it a breach of human rights. But 71% of our respondents indicated that protecting the family reputation is a defining factor in their decision-making around investing and tax structuring. As a result, what we have found is that many are becoming more conservative as they look to invest and really as a defense against complexity. The focus on transparency, however, has really become a double-edged sword, those unintended consequences. With increased transparency comes increased risk. Many people are concerned about this information falling into the wrong hands. Many are concerned about, financial safety. Many are concerned about their physical safety. All said that they understand the need for reporting, but how the information is kept and not disseminated is what is important. Many of you may have read recently about how the tax information of a number of US billionaires just became public, and everybody wonders, how did that happen? So there are currently US congressional inquiries of the Internal Revenue Service into how did that information get out. So is privacy the price to be paid, the lack of privacy the price to be paid for transparency? I certainly hope not. But this continues to give a focus on reputational management because nobody really wants to be thrust into the court of public opinion. Those who are, a little bit more insidious, less legal than our respondents will continue to look for ways to hide money around the world, and jurisdictions around the world will continue to develop ways to find them. Again, one of the unintended consequences will be that the rules that put in place impact everyone, even though they really shouldn't. So bottom line is, our respondents said they have no objection to reporting. The objection was to the potential audience. So with that, I will turn it back to Wendy to talk about relocation.
Thank you, Jeff. So when looking at relocation, context remains king when selecting a new jurisdiction. So those with children will typically value a strong education system, and those with business interests will value stability along with a reputation as a financial, technology or an investment centre with a strong labour market. As I mentioned earlier, the pandemic has given families the opportunity to reflect, and the travel restrictions cause focus to shift back to family ties and local connections. So comfort, confidence and security have joined stability as watchwords, and we've seen an increase in individuals wanting to return to their home country. The Knight Frank Wealth Report is a great report which aims to predict what may come next in relation to residential and commercial real estate markets. And this is also something that private clients take into consideration. And in the introduction to their 2021 report, they state behavioural changes we expected to play out over the next 5 years or even 10 years have happened in a matter of months. And they say, whilst travel still remains difficult, wealthy individuals still want options and to think about their plans. And the pandemic has affected the usual complex mix of decision-making drivers. And our research found that 80% of respondents thought that political stability is the #1 factor when selecting a new jurisdiction to relocate to. And this is followed by lifestyle and culture, and then the domestic tax landscape, which is always taken into consideration. One of our respondents said stability probably trumps low rates of taxation, but if you move purely for tax, you might well find yourself moving back again before long. And we've certainly seen examples of this. One client became non-resident, actually went non-resident, but lasted for the summer months because they didn't know anyone. And once summer had finished, their friends and family stopped visiting. So they returned to the UK. The events of 2020 have potentially thrown new players into the mix of popular relocation destinations. The global crisis has shone a light on stable jurisdictions with really strong leadership figures with well-coordinated crisis responses, such as New Zealand and Australia. And you'll hear from Kylie, Becky and Mark later, but Singapore has shown itself to be an attractive jurisdiction for both individuals and corporates. So individuals are really now therefore looking to navigate both public policy and political unrest. So relocation can be away from a given jurisdiction because of unfavourable policy changes, or it can be relocation to a jurisdiction because of favourable incentives. And with tax increases expected in many jurisdictions as they seek to recoup funds from COVID-related support schemes, questions around relocation may once again come to the fore. From a European perspective, those leaving the UK seem to increasingly favour countries with regimes with special arrangements for wealthy individuals such as Portugal, Italy and Malta. It can take a while to agree those arrangements locally, so this must be taken into account when considering the timetable for relocation. We're also seeing individuals who want to move to the UK to access the non-dom regime, in particular from the Far East, where schooling in the UK is considered a key motive. However, we also see many people moving to the US, which is a high tax jurisdiction. And as one of our US partners says, the IRS will welcome you with a great big bear hug. As always, the source of wealth and the nature of income or capital returns determine which is the best jurisdiction from a tax perspective. And as mentioned earlier, we are seeing individuals move back to their home jurisdiction and potentially becoming dual resident for lifestyle reasons, kind of post-COVID lockdown. So individuals should always consider the tax implications to remain compliant and avoid unexpected surprises following their arrival. And so for a pensioner, it may be a relatively straightforward exercise where they can go somewhere they want to enjoy the climate and what will be the tax implications in respect of their pension income. Are the implications different for lump sum withdrawals? An entrepreneur with different sources of income and gains may need to consider the tax implications with many countries having different regimes and different tax rates for those sources. And a global tax executive will likely to need to consider the tax implications on employment income and remuneration from different countries. So how does the location of choice tax foreign source income, and does it have a good network of double tax treaties? And there are also individuals who look to be resident nowhere. And whilst that's technically possible, this is not without practical difficulties, particularly when it comes to reporting under CRS and so on. On our global website, you'll find an interactive global map which shows 5 broad types of tax regime. So low tax or no tax, that's countries that offer a headline rate of tax on income and capital gains of 20% or less, such as Hong Kong, Guernsey or Jersey. Countries that offer a regime where people weren't born, where they can pay their tax on their foreign income or capital gains in accordance with the amount remitted to that country. So for example, the UK, Ireland or Malta, so they're a remittance basis regime. And then there are countries that offer tax breaks for new residents to their country on passive income and or capital gains, or on pensions or employment earnings, for example, Spain, New Zealand, Canada. And then there are countries that offer a lump sum tax regime where an agreed amount of tax can be paid on an annual basis, regardless of the amount of annual income or capital gains realised. For example, Switzerland and Italy. And then the 5th category is basically all others. It's also worth mentioning that individuals more than ever have had to understand the tax rules in relation to residency, where they've been forced to stay in a particular country due to the pandemic. Some countries have rules which have discounted those days for residency purposes or given concessionary treatments. But as always, the devil is in the detail. And double tax treaties may help here where somebody has become dual resident, but not always. It's also necessary to think about the impact on the residency position of any companies, where that individual is a director, if that jurisdiction has a concept of management and control for corporate tax purposes, or if that individual is creating a permanent establishment. So now is the time to review those structures to make sure they're still compliant. In many ways, taking all of the above into account, the core decision remains the same. What do you want and need from your physical base versus those other things that you're happy to travel for? So do you fly in and out rather than relocate for golf courses and beaches, for example? But as always, there's a lot to consider and many pitfalls for the unwary. So now, Jeff, if I hand back over to you for the next theme, please.
Thanks, Wendy. Family and generational wealth was, in my opinion, one of the key areas, the key important areas in our survey. And it was interesting. One of our respondents in their reply to us noted, regular people have kids, wealthy people have heirs. So I don't repeat this flippantly. I'm sure it was not meant that way when the respondent commented to us, but it really is important because it embodies so much. It sets our focus really to consider all aspects of what I would call the multi-generational family wealth enterprise. So this focus then really has many facets. It's just not how you invest. It's really not just about intergenerational wealth transfer. It includes everything like legacy planning, impact investing, philanthropy, doing good, having a social impact beyond philanthropy, recognizing that there are changing social attitudes among generations of family members. And in the end, it is all dramatically impacted by family dynamics. So our survey, as you might expect, found that there were wide cultural differences related to wealth creation and how it was viewed across the world. In the US, for example, wealth creation, the spirit of entrepreneurship, the struggling individual who finally made it is celebrated. But it seems to be that it is celebrated these days until the point where it becomes highly successful and that it is vilified. It was compared by one of our respondents to, rooting for the underdog golfer who, wins their first major And then after that, you continue to root for them. In Europe, we found that the view of wealth creation is much more discreet. And again, culturally across the world, there are many different views. We also found that with the next generation, or put another way, the rising generation, views wealth differently. And they looked at and expect businesses and the businesses that they invest in to embed their values into the actions that they take. This is much more than just looking at serving all stakeholders. It's a much broader view of communities, actions, and values. They also see wealth as a tool and not necessarily as an identity. This gives rise to then the focus on environmental, social, and governance investing, or ESG. And, but before we give the rising generation too much credit, let's remember that Bill Gates, who is part of the baby boomer generation like me, focuses his wealth on social impact investing, as well as philanthropy. And then Warren Buffett, who is older than that, part of what we call the greatest generation, has pledged to give away his wealth along with Bill Gates and many others of their generation. I mentioned that a certain level of wealth is being vilified in the US, and perhaps that's too strong a word. But there is definitely a focus on wealth inequality, not only in the US, but around the world. And it is constantly in the news. It really drives the aspect that the feeling that just philanthropy is not enough. There is an increasing view that social impact should be more tied to wealth creation. For example, I'm sure you've all read about the global retailers taken to task over ethical standards around working practices in the factories that produce their products. There is also a focus on green investing. But at least at this point, there is no standard or no definition of what is or is not green and what companies are or are not green. But having said that, with all this information and discussion around ESG and impact investing and going green, we asked our responders said that, that actions taken to match the rhetoric only really matched the rhetoric 6% of the time, very much so, and 50% of the time, moderately. So the rhetoric has not yet matched the actions taken. However, with the amount of rhetoric that there is, and the fact that there are many investment advisors rushing to create ESG funds, I think the next time we do this survey, we'll find that those percentages are much, much higher. So let's turn to philanthropy. So with the focus on impact investments, our respondents told us that there still is a significant role for philanthropy, but it's a much more engaged approach. It's more about, it's not just doing good, but achieving a tangible social impact. One of the respondents indicated that it is no longer just writing a check once a year. So in addition, many families have indicated that they use philanthropy as really the first step in educating the rising generation in their financial matters, and with a focus of bringing humanity to wealth. But like transparency, philanthropy can be a double-edged sword. In some cases, it has highlighted the view of wealth inequality, or the negative perception that the wealthy are dictating policy through philanthropy. And it really can get very frustrating, I'm sure, as one respondent said, I'm trying to do good, but it just seems like I can't win. Nonetheless, philanthropy can still be a vehicle for reputation management. And a good example of this is that giving related to COVID-19 has outstripped donations for any other natural disaster. This plays well into our respondents who have indicated that two of the most important concerns that they have for their family are reputation management and family governance. So some of the traits of the next generation that we have been talking about also translate into a different view of legacy and succession planning, according to almost half of our respondents. However, even without the encouragement of the next generation, 69% of our respondents indicating changing attitudes toward legacy and acknowledging that the passing of wealth may result in a strategic shift in their philosophy. This then gives rise to the issue of succession planning, which frequently stalls due to family dynamics. But nonetheless, our respondents still indicated that succession planning is at the top of their priorities for the next 12 months. So what are some of the reasons that our respondents have indicated that succession planning fails or does not succeed in the way that they would like? At the top of the list was the failure to communicate. And I think that almost anything comes down to good communication, but also the failure to manage expectations, particularly of the rising generation. Intergenerational tension, or said another way, family dynamics. The reluctance to relinquish control by the controlling generation. And an issue that all families have, regardless of wealth, and that is the reluctance to discuss sensitive or upsetting issues. The one I thought was really very interesting was trying to balance having, tough business discussions with the desire to have those discussions followed by a harmonious family dinner. There was also the issue surrounding not knowing how or when to have these conversations. What is the appropriate age to bring in family members? But in the end, our respondents acknowledged avoiding the issues doesn't make them go away. And this was also the area where they indicated that utilizing an outside advisor, somebody who was a third party but knew the family, had been involved in issues like this before, and can help in the process, would provide real value. In doing this, it's been interesting, but because we have found that family members will say things to us that they will not say to other family members, but can help through the process of developing the family governance and succession planning. So to conclude this section, we are, as Wendy mentioned earlier, undergoing the greatest generational wealth transfer ever. The rising generation, as we have noted, is much more connected, takes a different approach toward legacy. The landscape is increasingly complex, but those families who have prepared their heirs well will reap the rewards. And our research has shown, not only through this process, but others, that effective family governance is the key, because it provides the structure to collaborate and make decisions. But all generations must come together and engage, be willing to negotiate and compromise. And as a result, in doing it appropriately, avoid with the most important thing, then the result will be kind of avoiding the dynamics of what we have seen all too often is what has been referred to as, shirt sleeves to shirt sleeves in 3 generations. So with that, I will turn it over to Wendy to talk about the advisor of the future.
Thank you, Jeff. And this is our final theme. So what do private clients expect from their advisor looking forward into the future? And our research showed that private clients are placing new expectations upon the advisory community. So the advisor of the future must respond to the new challenges brought about by new trends in transparency, relocation, individual and family needs, whilst ensuring they are on top of technological advances. So technical expertise is of course expected and needed, but softer skills such as emotional intelligence have risen in value according to the research. What an advisor knows will of course be important, but how they deliver it and who they know will also matter. So advisors will need to help clients to see the big picture. Nothing sits in a silo anymore, and advisors will need to respond to this. So this doesn't mean that advisors will need to provide everything in-house, but instead the client will need to ensure that they have the right mix of advisors around them. And this mix involves different players and roles depending on the circumstances and needs of the client. So it could include a wealth manager, an accountant, a lawyer, and a trustee, and others. It could be argued that we're going back to the model where a client has an advisor who knows how everything should fit together. There, of course, remains a role for the specialist, but the game is changing. So as I said just now, emotional intelligence and the ability to build rapport and trust are key, as well as being a good listener. So private clients do not expect one individual to have every solution to every problem. So an advisor must acknowledge their own limits and maintain a network of trusted associates with expertise in areas and fields outside of their own. So it's essential to put the needs of the client first, with a clear understanding of their overall position, plans and ambitions. However, we cannot ignore technology, and technology drives change faster than anything. And the last 18 months have certainly seen an acceleration in technological advances. And remote meetings have become the norm. This type of webinar have become the norm, but we also know that many people are suffering from Zoom or Teams fatigue. So we'll see further steps towards embracing the greater use of technology, and advisors will need to continue to embrace innovation and improve their capabilities with technology. So advisors must therefore treat technological adoption not as a hygiene factor, but as an imperative. However, please don't be alarmed. Despite all of those advances in technology, trust and human connection should remain at the forefront of all of our minds. And computers may give us efficiency on certain tasks, but as somebody said to us when we were conducting the research, computers will be unable to step up, take a decision and be held accountable for that decision. So to summarise, the best advisors will use the right technology and educate themselves on how to use that technology. But the private client advisor relationship of the future will be centred, and it is now as well, really, on trust and soft social skills, as well as technical expertise, combined with the harnessing of cutting edge technologies. So that finishes our summary of the 4 themes, and I'll now hand over to Kylie, Becky and Mark for the views from the Asia Pacific region. Thank you.
Hello everyone, my name is Mark Pollock. I'm the leader of the BDO Asia Pacific Private Client Group, and I'm joined today by Kylie Liu, who's our leader of Asset and Wealth Management Tax in Singapore, and also her colleague Becky Hartley, who is also from our senior manager in our Singapore office. Kylie, if I can ask you to comment please on what you've seen some of the trends in the Asia Pacific region in recent years in relation to private groups.
Okay, so in terms of the Asia Pacific region, we are seeing a trend of high net worth families looking to move their assets onshore. Okay, so it's away from the tax haven jurisdictions such as the BVI and the Cayman Islands, and they are really looking to substance in jurisdictions such as Hong Kong and Singapore, where they are able to operate from and also live in. So with Singapore's stable, safe economy and its growing status as the financial hub with attractive tax incentives, we are seeing a large number of ultra high net worth families coming to build their family offices in Singapore in the last 2 years. Another rising trend in the recent years is that families with an international business presence, they are also coming to Singapore to set up global or regional headquarters to act as the control tower to manage and direct their global business activities. So as you can see from various reports in the media and also data released by the Monetary Authority of Singapore, which is our central bank, there were about 400 single-family offices operating in Singapore as at the end of last year, managing over $20 billion worth of assets. And this is a huge jump from just a few family offices in 2017 to several hundred in 2020. And of course, the number is still growing very quickly. So in terms of the profile of clients coming to Singapore, it also shifted from North America to North and Central Asia. Reports in February said that, the 9th richest person in the world, Google co-founder Sergey Brin, has opened a branch of his family office here. He also joins a number of other high net worth and ultra high net worth individuals who have set up shop here in Singapore, including Facebook co-founder Eduardo Severin, British investor James Dyson, Chinese hot pot chain Hai Di Lao co-founder Xu Ping, as well as the hedge fund operator Ray Dalio. So in terms of our clients' profile, about 60% of them are actually from North and East Asia, including China, Taiwan, Hong Kong, Japan, and Korea. For these clients, political stability and certainty is a key consideration. The recent political events affecting these countries in North Asian region have also triggered the surge in them coming to Singapore. We also have about 30% of our clients from Southeast Asia, which includes Indonesia, Malaysia, and the Philippines. This growing number is, of course, partly enhanced by the COVID-19 pandemic because these clients saw Singapore not just a safe haven for their assets, but also a safe haven for themselves and their families. The growing number is also a direct consequence of the recent law changes in those countries. In Indonesia, for example, under the recent signed Omnibus Law, which is the jobs creation law, it is now more efficient for Indonesian tax residents to actually hold and manage their assets through a structure, that means through a fund entity and a family office, as opposed to holding it under their individual name. Even for Singaporean clients, these structures provide the much desired tax certainty, for them when they are carrying on their investment activities. The remaining 10% is from the rest of the world, such as Central Asia, such as India, North America, as well as Europe. So to summarize the key drivers, why these high net worth families are actually coming to Singapore, it is because Singapore is a well-established financial sector, okay? We have a very stable political environment, and we have a very high standard of living, and this is particularly appealing to high net worth families. Also, in terms of tax incentives, I'll talk a little bit about that later on when I share with you a very typical family office structure. And of course, our ability to cope with the pandemic in times of crisis. And in terms of the global trend that has caused the increasing family offices being set up in Singapore, it's also because of the increased transparency and disclosure requirements. As we can see, people are moving away from offshore jurisdictions to Singapore and Hong Kong. Tax changes, yes, it's also a key driver because of the fact that you can get tax incentives in Singapore. It makes it more attractive to set up structures here. Non-tax changes, we talked about it, it's because of the political stability in Singapore as opposed to other countries. And of course, the pandemic, again, they are seeing Singapore as the safe haven to place not just their assets, but their families. So now I will let Becky share with you some of the key observations from her angle as well.
So I'm just going to discuss some of our recent observations in relation to the report's 4 key themes. And the focus is on Asia, as I've been in Singapore on secondment from London for nearly 3 years now. The first theme is transparency. So overall, we have seen that most clients are now in acceptance that transparency is here. And more transparent structures are necessary. And this has been particularly evident in Singapore, with transparency and substance often being some of the key reasons why our clients choose to set up their structures, such as family offices in Singapore. However, we have noticed that it's been more difficult for some wealthy individuals, for example, from North Asia, places such as China and Taiwan, to get on board with the idea of increased transparency, as there's a real concern for their privacy and safety. And this also came out of the report, with 71% of respondents being concerned about these risks too. So in the last few years, we've seen the introduction of the automatic exchange of information under FATCA and CRS, with data now being shared by over 100 jurisdictions internationally. And as a result of this, we are now starting to see global tax authorities asking questions where the data that they receive does not match their records. So for example, we've been working on many of these cases in the UK, where the UK tax authorities have sent out nudge letters to prompt taxpayers that they're aware of the existence of their offshore assets and that they might not have been correctly declared. So the next theme is relocation. So the report was interesting in that it showed us that tax is not always the key driver for relocation. And this corresponds to what we have seen for our clients in Asia. But we have seen a shift in mindset in recent years. And this is partly due to COVID, which has given families more time to take a step back, rethink and plan their affairs more carefully. And as part of this, we've also seen increased enthusiasm for relocation to Asia for clients from Western Europe. So for example, we've worked with a number of Western families who were keen to relocate to Singapore because they've seen it develop into an international financial hub. So it's a great place to manage their wealth, but also because of more recently how well Singapore has dealt with the pandemic. So considerations such as safety are also really important. And because safety is such a big concern, we've also seen a number of high net worth individuals from Hong Kong looking at alternative jurisdictions to relocate or hold assets in places such as Singapore because of the political instability in Hong Kong. So another one of the key themes is family and generational wealth. The first observation is that many of our clients are now prioritising the diversification of assets, which also came out in the report, with nearly 70% saying that this need is due to the current economic uncertainty, and we've seen this as well. Now, there are a number of themes in the investment world currently dominating the global economy, such as healthcare, financial technology, and digital transformation. And we have seen that all of these are, really big areas of focus in Asia, and in particular in Singapore on the fintech side. And another observation is that family offices in Asia are really embracing sustainable investing and following Western Europe in this area. We have seen significant growth around the idea of focusing on investments that benefit society, with more interest in environmental issues, healthcare and education. And in addition, we're seeing that the next generation are far more hands-on with philanthropy, and charitable giving really is a key focus in Asia. And following on from this, because we do see a real distinction between the older and younger generations, it can be difficult for the seniors to move away from a more traditional approach and allow the next generation to step in and take control, which can lead to family disputes. And this is really important now that we're seeing that next generational transfer of wealth. So we have seen an increased need to have a robust family governance plan in place. And finally, just to give you a brief overview of BDO as a global network and how this fits into the final theme from the report, which is advisor of the future. So we are trusted advisors and a go-to tax firm for high net worth and ultra high net worth individuals. We offer bespoke advice to suit our clients' needs and objectives. We provide a unique one-stop shop and holistic approach. Just to give you an example, in Singapore, we're advising close to 50% of the market share for family offices. And we have implemented over 200 structures for high net worth individuals in 2020 alone. And finally, as I mentioned, we are, of course, an international network, and we have dedicated private client teams to serve our clients in 167 jurisdictions.
Thanks, Becky. Kylie, can you briefly outline some of the more common structures that you see that help individuals and families achieve their objectives, both in relation to tax efficiency and/or migration?
Okay, so we talked a lot about family office structures. So what are the key features of family office? I'm just showing you a very simple family office structure just to briefly illustrate the concept. And as you can see, the structure generally comprises of two companies. So it's one asset holding entity, which is the incentivized fund, and the other one is the family office, which is essentially the management company. So one holds the asset and the other houses the people. Okay, so in terms of the ownership structure, well, it has to be owned by family members. It can be nuclear family or an extended family, but they must be family members. Okay, there should not be any third parties involved in the ownership structure. Otherwise, it would be considered a third party fund and not a single family office structure. Okay, however small the percentage, it will be a multi-family office if you have any third parties, which means it may have licensing requirements. Now, in terms of the strategic decisions, they should be made in Singapore and not elsewhere. This means that every quarterly at least, you should have meetings in Singapore to decide on your investment direction. Now, this is to enhance the substance in Singapore, and at the same time, it reduces the risk of the home country taxation. Okay, so for example, Malaysian clients, instead of making the decisions in Malaysia, they should be making the decisions in Singapore so that they are not challenged by the Malaysian tax authorities, that those income are Malaysian sourced income. Now, in terms of the licensing exemption, because this is the single family office which manages only family assets and not any third party assets, it is not required to be regulated by the Reserve Bank or the MAS, and it's also not required to hold an asset management license. This is the same elsewhere, okay? This is the same worldwide, and it applies to other financial centers such as Hong Kong as well. You don't need a license to manage your own assets. But the difference is that in Hong Kong, if you don't have an asset management license, then you can't apply for tax incentive. Now, in Singapore, even if you don't have a license, you can apply for the tax incentive. Okay, so we talked a lot about the tax incentive. Now, what tax incentive are we referring to? We're referring to the Section 13CA, 13R, and 13X incentives. So what do they exempt? I mean, what are they, right? They actually provide exemption from tax on income that is arising from the sale of your investments, such as your bonds, okay, your securities, also on dividend income, coupon, interest, etc. So therefore, these incentives exempt around income arising from approximately 95% of your investment portfolios placed with financial institutions. It also exempts income derived from investments in private equity and venture capital, as long as these investments are not linked to Singapore real estate. For example, if you invest in Singapore real estate or in an unlisted company which primarily holds Singapore real estate, then this would not be part of the qualifying investments, and income derived from these investments would not be exempt from tax. The incentives also exclude, okay, any investment income from cryptocurrency, as REITs, and also physical precious metals, such as your gold or your silver. Now, lastly, let's look at the investment professionals. Now, as the name indicates, this is a family office, so it's allowed to employ family members. even though they may not have any investment experience. Okay, the family members need not hold any investment management license. Okay, they just need to be ordinary people who look after their own investments. Some clients are worried about their qualification and some are worried about their age. Now, based on our dealings with the Reserve Bank as well as with the Ministry of Manpower, they are actually very open to have family members joining the family office to manage their own assets. And therefore, the age or qualification, it's not really a major concern or not a major consideration factor. So if you want to get permanent residency in Singapore immediately after setting up the family office, okay, it is possible, but you have to really set a very big scale family office managing approximately about 200 million worth of assets. Otherwise, you can always start by just getting an employment pass first, and then you come to Singapore to live and work, and then, after a few years, you're eligible to apply for permanent residency in Singapore. So just to summarize some of the key objectives, why families all over the world, okay, they come to Singapore, what do they want to achieve from the setting up of single family office in Singapore? Now, number one, they want to have tax efficiency and certainty. So rather than saying that, it's a BDI company that is enjoying tax haven status, it is better to say that it is a Singapore tax resident company enjoying tax exemption granted by our central bank. And it is granted for the life of the company. So as long as you keep the company alive, you don't liquidate the company, you still have the tax incentive. You don't have to renew it every 5 years or every 10 years. And as opposed to putting assets in personal name and debating whether it is indeed better and whether the income should be taxable or not, now by putting it into the fund with the tax incentive, you have the certainty that the income will be tax exempt. So there will be absolutely no gray area. And this applies to anyone who is already in Singapore or who intends to come to Singapore. Okay. Number two is for immigration reasons. A lot of people, they want to come to Singapore because it's seen as a safe haven, and it's actually quite a livable place, except that it's just a bit hot. Okay, so they use these structures to actually get employment pass, and at this moment, because of the pandemic, this seems to be the only viable structure for employment pass applications to go through. So just now I have mentioned, if the scale of the family office is big, then you can also apply for Singapore permanent residency and straight away. Okay. Now, but of course, if the clients already have Singapore PR, then you can use the structure to apply, Singapore citizenship, because you can use the structure to demonstrate your economic contribution to Singapore, which is important not just for PR renewals, but also for citizenship applications. And last but not the least, of course, we can use the structure as part of the succession planning process, okay? Because usually these structures, we build a trust on top, okay? Whether it's a new trust or existing trust. Now, the family office can be used as a platform to train the next generation to manage the private wealth of the family or the offshore wealth of the family, okay? So Mark, over to you in terms of, typical structures in Australia that you can share with us.
Thanks, Kylie. Australia obviously doesn't have the same incentives, in fact, any incentives to attract family offices to our country. And so as a result of that, I think it's more likely that family offices would move from Australia to Singapore to set up. For those that decide that they love the climate in Australia and want to stay in Australia, what we find with family offices is that the structures that are set up are often restricted by the existing legal entities that are in place at the moment. Because Australia has a capital gains tax and stamp duty on transfers of property, to try and unwind an existing structure and to create a new structure can create a lot of tax liabilities. So we often see structures like the one that I have on that particular slide, which involves existing companies, existing discretionary trusts, perhaps a testamentary trust that's been created on the death of the parents, with assets being left and managed by the future generation through the trustee company. And trustee companies in Australia are often, more often than not, privately held companies. We don't have independent trustee companies that manage assets. It's typically trustee companies that are owned by the family. Kylie, inheritance taxes and wealth taxes are a big issue in a number of countries, including the United States and United Kingdom. Do you see that becoming a major issue in Singapore?
Thanks, Mark. I don't see wealth tax becoming an issue in Singapore, and it's unlikely that the government will introduce any form of wealth taxes in Singapore anytime soon. In fact, it is likely that Singapore will hold off, any higher taxes just to seek to attract more high net worth and ultra high net worth families to Singapore. So the multiplier effect, from these wealthy individuals and families would, they can bring the benefits to Singapore to drive the recovery of Singapore's economy during post-pandemic times.
Fantastic. I'd like to thank both Kylie and Becky for their presentations today, and I'll hand you back to Wendy and Jeff.
What does the rest of the year look like? Well, what we found through our survey, and really have been finding out for the last several years, is that the demand for family offices will continue to grow. And the definition, family office has a lot of different definitions. We have some clients who have 1 or 2 people in their family office and then outsource everything else. And then we have clients whose family offices include 100 or more people. The key part, though, is to make sure that that the family wealth enterprise is professionally managed. We usually see it first come up when a family who may have a family business worth $100 million, say, sells the business. So previously they had a $100 million business and they had employees who took care of a lot of the family matters. Now they still have a $100 million family wealth enterprise after the sale, but no people to help them with that. As we talk to clients through the family office process, we usually go through a strategy of what would you like to have control over? What do you want to outsource? Should you be part of a multifamily office? And what are the costs? Because family offices are expensive. I think we're going to see continued view of priorities around legacy, philanthropy, investing, and especially with the impact of multi-generations within the family wealth enterprise. Global information sharing is only going to continue. Somebody out there is going to want to capture that other 10% of GDP that is not automatically shared at this point. As Wendy mentioned, a lot of people have either been trapped in another country and couldn't travel and became an unexpected resident, or tried another location and want to return home. The next and rising generation will continue to have an impact, and a much greater impact as we go forward on the deployment of their family's wealth. And there's been a lot of unsettling things, I think, that we've talked about, as well as the last 15 months have been very unsettling for everybody. But utilizing this information and developing a strategic plan for the future, hopefully, will bring stability back to our lives. So with that, I will turn it over to Wendy to conclude.
Thank you, Jeff. And actually, Paul is going to come on now, and just there's been a few questions that Paul's picked up for us. And Jeff, feel free to chip in as we go through. So, Paul.
Thank you, Wendy. So the first one, we had 3 during the period, which we've got about 10 minutes left, so that's perfect. Lee in London, funnily enough, posed a question about the rise of wealth taxes and other taxes, which I think was the end slide for Kylie. So I think they don't think there's going to be much change. I think in the UK, we certainly were expecting change in our budget earlier this year, or certainly around the tax day when they were going to release certain proposed documents and consultations, etc. And as a consequence, there was quite a lot of activity of people making gifts and accelerating sales of assets. The reality was that actually nothing happened immediately, but that's not to say that we won't get tax increases. I think a wealth tax is probably a stretch because it's such a complicated change to our tax code to introduce something like that. But increases in capital gains tax or amendments to our inheritance tax regime could definitely happen. And we've had two recent reports, one from the Office of Tax Simplification and one from the All-Party Parliamentary Group, proposing different ways of amending our taxation of inheritance tax and simplifying the system. But some of the proposals quite radical. And if a client was considering reorganizing their family affairs, for instance, some of the reliefs that could enable them to do that now may go. So I think we could see more and more attention on that and focus during the lifetime of this Parliament on the basis that capital gains tax could go up or inheritance tax could change. I did have a client who's in Poland at the moment, and in Poland the CGT rate is 19%. And actually in comparison to other European jurisdictions, 19% is not actually particularly low. It's reasonably high, and our base rate here is 20%, so that's quite high. So any idea that you could push it up to income tax rates would seem unlikely. But I think, Jeff, we've just had some announcements in the US, haven't we, about increases in tax rates there?
Yeah, yes, we have. The new administration not only has proposed increasing tax rates, but a wealth tax and the elimination of what's called step up in basis at death, where assets that go from a decedent to their heirs take on a tax basis of fair market value at the date of death. And as I said, including a wealth tax, including taxes on putting assets into a trust. They would be deemed to have been sold as of that date and a tax paid. And a number of these are quite disconcerting, in particular because usually you have a tax in the US, you have a tax incidence on the sale of something when you sold it and you have the cash. Whereas when assets go from a decedent to their heirs, there is no sale, and to have a tax liability without the cash to pay it is very disconcerting, to say the least. But also, proposed increase in tax rates relative to dividends and capital gains, Paul.
And actually, that's interesting because some of those changes there are certainly ones that were brought out in some of the reports that we've had published recently. And given the current focus on amending corporate tax regimes internationally, we had a recent rise in the corporate tax rate in the UK coming in 2 years' time. I wonder if the focus will be on individuals next. So that was a good question, Lee. Thank you. Hopefully we answered it. I don't think we did, but we did our best. Another question, Steve from Jersey. It's a long question, but if I summarize it at the end, it says, we focus a lot on structuring tax and reporting, but do we do enough to ensure advisors can help on succession planning? So I think that's more around, sometimes we bring in third parties perhaps to support in the conversations we have with clients about what they want to do. Should we ourselves be upskilling to be able to do that sort of work? Now in the UK, maybe I'll kick off. We have recently Catherine Grum, who may be known to a lot of people on the call, has joined us about 9 months ago to actually help in that specific area. It's all very good for people like Wendy and I just to really focus on the tax aspect of what clients need to do and achieve. I would like to think that perhaps we've developed skills over time that enable us to have wider conversations with clients around their aims. But Catherine brings another dimension to our service line, and we look forward to working with her in developing the wider conversation with clients. Any comment on the US side, Jeff?
Certainly, Paul. We in the US started a family office a few years ago, and one of the focuses, really at the request of our clients, was to help in the succession planning area. So we have people who will assist clients in developing succession planning, which really starts with family governance and determining the issues that are important to the family. And most of these issues obviously have nothing to do with tax, but they're all about helping the family navigate the transfer of the family wealth enterprise.
Yeah, that sounds very similar to the offering that we're developing in the UK. And I think what lockdown has shown us is an increased focus by clients around their mortality and thinking the bigger picture and not just about the tax savings. But still, it's just unbelievable how many clients and prospects we meet who haven't got wills, let alone more more complicated estate planning. So
Yes.
small steps for some of these people. Now, perhaps the last question, looking at the time, Roger in Zurich. Roger, hi. I hope you're well. Look forward to seeing you when we're allowed to get back out there. Roger has asked Wendy, did you notice a difference, the importance of personal relationship and trust based on age of respondents?
Yeah, and only 3% of our respondents identified themselves as next generation. So we didn't really look at the differences with age on this bit of research, but going forward, I think we'll ask that question. So next time when we go out and survey and interview, we'll increase our resources to focus on the younger generation as well to get their insights.
Yeah, and I can pick up a bit maybe on it with a UK focus, because I was part of the group we had within the BDO Young UK firm, where we were looking at the future requirements of our business and what our clients would want. And we did a fair degree of research and looked at research done independently by others. And one of the things that did come out was the belief, which I think is probably true, that the next gen they'll still value personal relationships and trust, etc., with their advisors, but they may also be far more inclined to perhaps shop around and look at different offerings from different firms, and maybe not be quite as loyal as the older generation and those sort of long-term relationships we've experienced to date. I don't know, Jeff, if there's a US aspect on that you can bring.
Paul, we haven't done any research as well, but just anecdotally, I would agree with you that the concept in the US is certainly still the same.
Good. Well, I think those are all our questions.
Thank you, Paul. So it's just for me to say thank you to Paul and Jeff, and also to Victoria and Lara, who've helped put everything together, and for Lara for managing to get the video up and working. Thanks to Kylie, Mark and Becky, who are probably fast asleep now. And also thank you all very much for joining us and for listening. And I hope you all keep well. Have a nice evening all.
Goodbye all.
Bye.
Goodbye.